Hey guys, and welcome to our first episode of JE Empire Talks, where we break down wealth, investing, real estate, and occasionally break each other's nerves.
More than often.
Today we're talking about cash flow versus equity and why one of us wants the consistent cha-ching every month.
Because I like my money that actually shows up on time, not some maybe one day appreciation.
I'm sure that we all want what we want. Me, I want everything. I want the cash flow, I want the appreciation, the tax write-offs, and I want the power that equity gives in the long game.
What is cash flow versus equity? Cash flow is simple. It's the money that's left after you pay all your expenses, mortgage, taxes, insurance. It's your play money. It's what helps us live, invest more, and sleep at night.
It helps you sleep at night. Equity, on the other hand, is your ownership in the property. It's the value of the home minus what you owe on it. It's the long game, and it's what matters. It's the wealth builder, the don't touch it now, but flex it later kind of money.
Cash flow is like dating, instant gratification. Equity, it's like marriage. It takes time and sometimes a lot of therapy.
I'm pretty sure. I like equity because it's what you're going to get at the end of the game. And I want all of it. Why? I want to be able to get cash flow every month. And then I also want to be able to appreciate on these properties and also depreciate them along the way so we don't have to owe so much money to Uncle Sam. But you are so focused on just the cash flow. Every time that we're going to go get a new property, all you ever want to talk about is, well, how much is it going to cash flow every month? But it's so much more than that, don't you think?
I agree. It is
Oh,
more
now
than
you
that.
agree?
I agree. After some time,
But why we've been fighting this whole time then? Now you agree. Now let's talk about how to calculate net worth. Net worth equals your assets minus your liabilities. What are your assets? What you own, your property, your savings, your cars, your investments. And your liabilities is what you owe. Your mortgages, the credit cards that I love, loans. So what do? You add up all your assets and then you subtract what you owe. Boom, that's your net worth.
Most people think that being rich is having a high salary. That's not always the case. It's about how many income producing properties or assets that you own.
It's not only what you own, but it's how diversified your portfolio is. So you, yes, might have a lot of properties, but you might have a lot of stocks. You might have a lot of REITs. You might have different businesses that are passive income that they're giving you some form of stream of income every month. All of that together and how you diversify your portfolio is really how you build yourself up to a higher net worth. And what really allows you at the end of the day, that when one of these properties isn't producing or you're waiting for it to appreciate and it's not cash flowing that much, you have all these other streams of revenue coming in that supplement one another. Why debt isn't always a bad thing. This is where the game changes. Not all debt is bad. Some debt actually makes you money, especially in real estate.
That's right. When a tenant is paying your mortgage, that's leverage income, and you're building equity while collecting rent.
And listen, little Kim said it. Why spend mine when I can spend yours? She wasn't talking about real estate, but she was definitely onto something.
Yeah, sure. We use other people's money, the bank's money, private lenders' money, loans to acquire assets. We don't drain our savings, to grow. You use always the bank's money, if you're able to get the money, use their money. Why are you going to use your own money for? That makes no sense. You have your savings or whatever you save in your account, keep that money there, just give a percentage, whether it's 20%, 30% down, 40% down on each property, and then use that, put the cash down for the 20% for the property and then buy another property, so why use all your money, all your savings on two properties or one property when you could use that money that you have on multiple properties, right?
It's not only that, it's that if you have a really good deal and you don't have the money for it, a lot of people are like, well, then I guess I'm not going to join in on that deal. But that shouldn't be the case. You shouldn't go into a deal thinking whether or not you have the money for it. The money's the last thing that you should worry about. The first thing that you need to worry about is finding a deal. Once you have that really good deal, if it really is a good deal and it is going to be, something that's going to produce X amount of money over X amount of time, it's in a good market, it's going to appreciate, you're getting it under market value at the moment when you're buying it, and it has so much room to grow, why wouldn't you do crowdfunding? Like, why wouldn't you want to bring somebody in, your mom, your sister, your uncles, whoever, your friends, and bring them in? You do some crowdfunding, you gather up all this money, and you figure out the legalities about it and the way to do it along the way. I think that a lot of people are scared to make that move. You're not asking people for money to invest in your business. You're asking people to invest in something that is going to grow and appreciate and that they're going to cash flow from as well. You shouldn't be scared to bring other people in. There's enough for everybody to eat.
Scare money.
Don't make money.
Don't make money.
Let's move on to tax magic. So, tax benefits and depreciation. Depreciation allows you to write off the cost of the property over time, even while it's going up in value.
Which means Uncle Sam thinks you're losing money while you're actually making it. Now, one point on that is also that I wanted to bring up. Sometimes when you pay off these properties, you're not able to write them off as a loss, right?
Not while, so you have to have some debt on the property in order for you to write it off.
So you always have to think about things like that. Back to using the bank's money, where you give a certain amount of percentage, whether it's 50% down. You always want to owe some type of money so you could do things like this.
You do. And leveraging debt is not a bad thing. A lot of people are scared to leverage debt and to have debt on a property, but it's something that you can play with even at the end of the year when you go to do your taxes. It's something that you can leverage to your benefit. And it's something that maybe right now, for instance, I think this year we had that happen with our taxes, that we weren't able to claim the loss due to our income. We weren't able to claim that loss that we had on some of our properties because we had just bought them and we did a lot of remodeling. That loss doesn't leave, it stays there. So let's say, to give you a figure, those 50K that we had in losses, even though we weren't able to use it this tax year that just passed, that doesn't mean that we can't use it next year. And next year, if we have a profit of, let's say, 60,000, we would only be actually assuming 10K, because you would apply those 50K in losses to those 60,000.
Yep.
So it's something that you really get to play with, and it's a built-in tax hack. It's a built-in tax hack in terms of real estate. That's why the big names like Grant Cardone, Barbara Corcoran, and Robert Karwowski, they're always saying, don't sell. You need to refinance these properties. You need to re-leverage. And then with that money, you have to buy more. So, and it's back to the same concept. Why are you going to spend your own money when you can spend the bank's money? You can refinance one of these properties that have appraised, and then you get that money and you invest it in another deal, and you go doing the same thing over and over again. It's just the way to do it.
Yeah, and if you have, I don't know, $250,000, let's just say, right, to pay off one apartment, why pay that apartment off, right? When you could probably give out of that $200,000 or $200,000 that you have to buy that apartment clear and free, you could actually give a down payment on probably, I don't know, just throw a number, 3 apartments, right? Something like that, or 2, but that's 2 or 3 more than that one, right? So it kind of evens out where you're gonna have that rental income for that one apartment, right? So now you have 3 or 4 that's gonna produce you the same income.
Why are you talking like me?
But I thought
that you didn't want that. I thought that you didn't care about appreciation.
But then there goes to your assets. Now you have 3 or 4 properties instead of one, right? You're gonna have the same income, right? Because say, yeah, you give a percentage down on each of those apartments, but if you add up, those 3 or 4 are gonna give you the same amount that one is gonna give you free and clear. But now you have more, like I said, more assets, and you're worth more. You have a bigger portfolio. Your net worth is only gonna go up. So don't use all your money just to clear and free 1 or 2 properties. You're gonna, yeah, no headaches. I don't owe nothing to the bank. Yes, but your net worth is only that, right? Your portfolio is only 1 or 2 apartments. Whether you have that money, you play with that money, You use the bank's money. That's where you're at. Don't use your money. Use the bank's money or a loaner. Someone else. It could be a third party, whatever. But just don't use your money. Just give the 30% down, 40% down. And then goes Uncle Sam. Write it off as a loss, and that's going to help in the end run.
It's not only that, it's just that you're able. I think at the end of the day, everybody's different. So my long game might not be the same as your long game. You know, what I'm doing this for is not the same reasons or the same goals that you might have. So if my goal, or at least for right now, I believe that our goal is generational wealth and to actually have something for the future, for our children, for our family, something that we are able to live passively from. Um, it's not about how much I'm cash flowing every month. Yes, I am going to cash flow. And at the end of the day, the way that we work our numbers, we usually cash flow more on our properties over the regular margins, you know? So we're looking at cash flowing probably from one property at times $700, $800, just to give you a round figure, to not be talking in percentages. Um, and it's something that is beneficial to us, yes, in today's day, so month to month, but long term wise, you're going to be acquiring such a diverse portfolio in terms of your investments and in all the properties that you have, that 5 years from now you're sitting on 50 something plus properties or more.
Yep.
So that's really where it's at. And it's in terms of, what are your goals? What's your long game? What is it that you're doing this for? If you're just doing this because you want to have 5 properties, and off of all these 5 properties you make 2,000 or 1,000 something plus on each one, hey, then go for it. Stay with your 5 properties and make it work. But if you're really in this because you want to build an empire and you want to build something very big for you and your family, and something that's sustainable and that's going to be here for the long term, then it's not really just about cash flowing every month. It's about the equity. It's about actually building wealth.
Yep, and that's what we're trying to do. We're trying to build our empire. So
We already built our empire. We continue to stack on it. So now let's talk about why Maylene wants both. I want the monthly cash flow so we can travel, reinvest, and have freedom now. But I also want the equity because that's the legacy money. That's what builds generational wealth.
I just don't want to be house rich and cash broke. You get me?
But that's why, dude, you're so frustrating sometimes. I thought that we had already worked past this. But this is why we blend strategies. Yes, some properties are cash flow heavy, and then there's others that are for long-term equity builders in really great market. Together, we balance it out. Like you and me, baby, yin and the yang.
Oh no. How do the big dogs do it? They don't buy homes, they buy portfolios. They raise private capital. They structure creative deals.
They use partnerships, seller financing, DSCR loans, and private lenders. They scale by focusing on velocity of money, not just saving pennies. I think that's a really big thing, in that you can't just be counting your pennies and we have X amount and this is what we're going to invest and this is what I can do and what I can't do. No, you need to look at the deal. The bigger the deal, the better. The better the deal, the more people that are going to want to come in and that are going to want to invest in your deal and that are going to want to work with you. You cannot be scared to make money. You just really cannot.
They stay liquid and they protect their equity like it's a trophy wife.
Yeah, and you want a trophy wife and you also want the side piece, but that ain't gonna happen. This isn't that type of show. I just need to make sure of that. But you still need to date the cash flow on the side to make him happy. But let me reiterate that we're not doing that right now. If you're just starting out and don't know where to begin, download our couples cash flow starter kit. It breaks down these concepts with real numbers, checklists, and also exit strategies, which are so important. You have to have an exit strategy every time that you're going into a deal.
And if you want help mapping your goals, the Budget Dog Academy helped us create a plan that works for our real life, not just get rich fantasy type.
So the link is in the description. Let's build wealth together.